Gold solves the housing crisis. Hi, everyone, and welcome to Ainslie Insights, brought to you by ainslie.com.au, the home of Ainslie Bullion, Ainslie Crypto, Ainslie Wealth, and the Gold and Silver Standard. Be sure to have a look. Today, we welcome back Drew, who's making a very provocative statement there. He's a pretty smart guy. Our audience knows that, but he's apparently solved the housing crisis with gold. Very fascinated to dig into this today. How are you going today, Drew?
Good, Chris. How are you?
Yeah, good. So, look, are you that smart? Have you actually just solved housing? There isn't really a problem at all. Talk us through your idea, because it's a very interesting one that you have around what's actually going on here when you think about the housing crisis relative to currency.
Absolutely not that smart. It's a very simple argument. It's definitely not rocket science. But I think the simplicity of it is very compelling, and it's really hard to argue with it once you dig into some numbers. So, there's obviously a housing affordability crisis. That's no secret, and a lot of people will attribute that to supply shortages, building regulation, political, decisions made by the party in power, and they think they can vote their way into housing affordability. Unfortunately, you just scratch a little bit underneath the surface, and there's a fairly strong argument to be made that it's not so much an issue of government policy or supply or building regulation or population. It's more an issue of fiat debasement. And it's really just like every other hard asset that has limited supply. It's the unlimited supply of the fiat currency that it's priced in that is losing value exponentially at this point. That's leading to the affordability crisis. And a very simple way to look at that is to essentially price housing in gold and see how unaffordable it's become in the last couple of decades, whether that unaffordability has actually gone up or not, and comparing that to the Aussie dollar. So I'll let the charts do the heavy lifting for me on this one, and just to lay a little bit of groundwork first.
And while you're bringing those charts up, I just have a point to make, or a sort of question or topic to talk about here, which is you make the point there. You hear politicians particularly talking about housing affordability as a pretty hot topic for just generally when it's around election time. It's something that everyone is feeling, so it's something that they feel they can push on. But you never hear really any politician talking about currency debasement, and I think that's obviously deliberate, but it's an important point to make.
Great point. And the reason for that, I think, is because fiat debasement is fundamental to the financial system that we exist in today. And it's basically baked into the cake. So it's something that they can do nothing about. Making people aware of a problem that they cannot fix is not going to be very popular. And, you know, like I was saying before, voting a different party in is not going to solve this problem because it is systemic. It's fundamental to the way the political and financial system that we have is set up. There's nothing any politician can do about it. They're not going to talk about it. They'll say what needs to be said to placate their target audience. And both sides of the political sphere are feeling the pain of this, and neither side can do anything about it. There needs to be a systemic overhaul. And short of an individual somehow overhauling the entire system, there is a very simple solution to this problem, right? So it's not all doom and gloom. There is a simple solution that individuals can use to solve the housing crisis for themselves on a individual basis for their families. And it essentially involves saving for housing in hard assets. So using hard assets to buy hard assets, and that way you're keeping pace with asset inflation. Like I said, it's a very simple theory. The charts will do the heavy lifting in terms of proving it. But if you're saving in something that's losing value over time to buy something, to pay a deposit on something that's exponentially gaining value, and then to use leverage and interest to pay the rest of it off, I mean, that's a really bad deal. So if at the very, leverage is okay, you're essentially shorting the Australian dollar by getting leverage on a hard asset. Sure, that's probably not the worst trade in the world anyway. But saving for a deposit, whether that takes someone 5, 10 years, when they just start working, that well, that time frame will just get longer and longer. What used to take 2 or 3 years will now take 6 or 7 years. And that's the housing crisis. That's why people are getting into their 30s and then buying their first home rather than what used to be in their 20s. And that's why it takes two incomes to service the debt on that home, because the asset inflation is exponential at this point. And on that note, let me just quickly pull up the chart of the US M2 money supply. So this is obviously American, but the same principles apply globally. You can say steady increase, and I'm not sure if you can see my cursor there, but this little blip right there, that's around 2020, or that is 2020. And that's the stimulus printing that took place around that time. And it's no secret what happened to grocery prices, what happened to housing and house prices. And this housing affordability crisis really got exacerbated after COVID, after that 2020 stimulus printing. So this is steady inflation, or this is the money supply increasing steadily, or the currency being devalued steadily. And this is the currency being devalued exponentially. Now,
And even if you just looking at that chart, like if you were to argue that currently it's sort of returned to the average, we're still that average is still not great, right? Like it's even if they pulled back, they didn't actually reverse anything. There was no reversal of the increase. It was just a slowing down of the increase, bringing it back to the usual rate of going up.
absolutely. So you'd see an exponential increase, and then you'd see a slowdown of that increase to bring the average back to the median. But you're not looking at house prices reducing in value. If house prices were reducing in value, um, that you're looking at deflation. When there's asset price deflation to that extent, that's basically a serious recession. So the way the system is built, everyone wants house prices to go down, but house prices going down is usually coinciding with a broad-based recession, and that's when people are losing their jobs as well. So you've got to sort of pick your poison. Do you want good employment, a lot of work opportunities, and good pay with houses going up in value? Or would you rather a landscape, just based on the way the current system is set up, where houses are reducing in value, land is getting cheaper, but no one has a job and is on government benefits, which in turn is actually going to end up, leading to the money supply increasing again, stimulating the economy, and we know how it goes. And then house pricing just continues up from there. But um, look, I'll quickly overlay gold on that chart as well, just to give you an idea of how gold keeps up with this. But really, before we go too much further, let's just have a quick look at where housing is and that little exponential peak or exponential increase in M2 that we looked at earlier. Again, looking at this here, that's the exact same time, 2020, 2020, 2020, and 2020 there. So we can see what happened in terms of all of these metrics basically saying the same thing. Dwelling value to income ratio, so that's the average annual income in comparison to the the median house price. So house price divided by income. We went from 6 to 8, which means if house pricing stayed consistent in cost, would have taken someone on average 6 years or so to save up to buy a house outright. Now it's 8, but of course during those 8 years, the house price is going to continue increasing, which is why people need to use leverage to buy homes in the first place. But that's gone from 6 to 8 years to save a 20% deposit. Has gone from 8 to 10, and that's just been steadily increasing since really we got off the gold standard. Percentage of income, it's gone from about 30 to 50. That's a fair whack. And then rent's gone up a fair bit as well, from 25% of your income to about a third of your income. So everyone knows this. This is not new information, but it's just interesting to see the timing coinciding with that M2 exponential increase. It's really hard to argue what's causing this. Increase in money supply and housing went up at the exact same time at a similar angle. It's not that we've had a huge issue with anything else since 2020 that you can say can be correlated this closely. And obviously, digging into the way currency works, we know that asset inflation is what follows almost in real time with an increase in the currency supply. Now, just quickly overlaying the gold chart on M2. This is clearly the solution. If the currency is being devalued as the currency supply increases, gold is keeping pace with that by increasing in value, along with what would be housing. Now, it's not going to go up 1-to-1 with housing at all times. It probably is a bit of an oscillator. But if your gold is going up, you're generally keeping pace with asset price inflation. So your housing at some times should actually be getting cheaper while the economy is going up, while we're not in recession, while we're actually having booming employment. Your housing could still get cheaper when priced in gold. If your housing is getting cheaper as priced in Australian dollars, we're in a recession, and that's not really what we want to be hoping for. So, to again, like I said, let the charts really do the heavy lifting for me. Here's an interesting one. This is gold and housing, and you can see they generally move up together. So this is obviously the gold price in yellow, and you can see there are times when housing is outperforming. You can see there are times when gold is outperforming. Now, here's an interesting one as well. I don't think I can go an entire insights without mentioning the 18.6-year land cycle. But that's the peak of the previous 18.6-year land cycle. We saw land declining in value, and look at what gold did. Gold dropped a little bit. This is where the S&P dropped as well, and then gold just did that. Massively outperformed land. So for people that are leveraged in investment properties, and people that have, obviously you're not going to sell the home that you live in, but people that have investment properties, you really want to be buying at the base of that 18.6-year cycle and then running it up to the top. That's a nice 20-year trade. And then you buy at the base of the next cycle, run it to the top. And where you find shelter from the storm during this time, taking profits into land and moving it into gold, I mean, you've got massive appreciation and you get to buy your land cheaper at the start of the next cycle. So every 18.6 years, and we're at that point now where the average peak would be late 2025. And even looking at the longest cycle on record, you'd be looking at a peak no later than 2028. So we're not far from something like that at the moment. But really the point of this is if you're saving in gold to buy land, you're doing okay. If you invert this chart, you'll see the inverse of this chart is basically the Australian dollar, or in this case, the US dollar, losing value against these hard assets. This is land or homes priced in gold, and you can see it's not trending up like this one, where it's priced in dollars. Instead, when housing is priced in gold, it's an oscillator. It's going sideways. So there are times when one is outperforming the other, but really you're in a sideways chop. Having a look here at a final one to really, I think, drive this point home. This is more of a short-term chart, but here we're looking at housing from 2006. So just over the last 20 years. And you can see in the last 20 years, this is what housing has done when priced in dollars. So obviously 06, that was leading into the global financial crisis. This bottom here was the base or the start of the current 18.6-year land cycle. And, this is roughly 20 years now. So that is the current 18.6-year land cycle. You've got some nice gains there. However, when you price the same thing in gold, starting at the exact same point, housing got cheaper in gold, leading into the base of the previous 18.6-year land cycle, where in the previous chart where we saw gold continuing up while land was moving down, that's represented here as well in this ratio. But over the course of this 18.6-year land cycle, housing hasn't even recovered the peak of the previous one when priced in gold. Looking at it from 06 to today, housing has gotten 150% more expensive when priced in dollars, but it's actually half off when priced in gold. So if you just held gold from this point here, was nearly the peak of the cycle where you averaged out of land into gold, getting into the peak of the previous cycle, and held gold up to today, you could still buy a house for half off, roughly. These are obviously broad-based ETFs and, the global gold price priced in US dollars. So this would differ from currency to currency and, market to market. But this just gives you an idea of housing is getting that much more expensive in dollars and is getting that much cheaper when priced in gold. So the housing affordability crisis when priced in gold is actually not much of a crisis at all. Housing is getting cheaper.
Now, look, people are going to challenge that and say, okay, you might be right technically, but that's not practical because for me, I still can't afford the house. It's still an issue, but there is a practical solution to that there. You're not really talking entirely in hypotheticals because that is absolutely something that you can do. You can save for that house in gold. That's something that is actually possible to do. So although a lot of people will default to criticizing that sort of approach to thinking about it, the data is pretty clear, right? Like it's not difficult to see when you let the charts do the heavy lifting, as you said, that there is a better way to do it than just keep putting money away each week into your bank account to try and build up a house deposit.
Spot on. It comes back to that same argument of you can save in a term deposit and earn interest that will underperform asset inflation significantly, or you can benefit from asset inflation. We can't change the rules of the game, but if we learn what those rules are, rather than being a victim of asset inflation, rather than being a victim of currency debasement, if you can't change it, why not benefit from it? Why not improve your standing or become wealthier as a result of currency debasement with a very simple solution of just holding hard assets, which are going to increase in value? It's really the currency that's decreasing in value. And in terms of a solution, I mean, there's probably a few people watching this that are a little bit younger that maybe want to be saving for a house over the next 5 years. The simple solution is your pay that will be coming in, that you would be putting into your long-term savings account that's going to earn interest. You could use that to just buy gold or silver instead. Silver is probably a bit more of an active strategy, but with gold, set and forget, just buy gold and you can build that up over the 5 or 6 years that you're planning to save for a house. And what you might find is if it takes 8 years, according to the data that we looked at today, to save for a house, that same metric might say 12 years down, by the time you're ready to actually go in for the house. Well, look, I was looking at buying a house in cash. Obviously, most people will be happy to deal with banks and most people will be happy to put down a deposit. But let's say it's going to take you 3 to 4 years and that will keep increasing. If you're doing it in gold, that will reduce dramatically. And there'll be a lot of people watching this probably who are a bit older, but maybe their kids are looking at saving for their homes or they're going to help their kids buy their first homes. The simple solution is essentially to just move money into hard assets as a savings mechanism. And Ainslie Saver actually is a great option for something like that. So, probably a good time to plug that. And we can leave a link to it in the description as well. But dollar cost averaging into precious metals regularly, consistently, in a disciplined fashion will help you benefit from currency debasement rather than being a victim of it. So I simple solution, not rocket science at all. And it's really something that doesn't require a change of political party or an overhaul of the entire system.
Look, can't beat 'em, join 'em is how I'm how I'm boiling that all down. There is a solution there. Fascinating as always. You've tackled the biggest of issues at the moment and solved it down into a very simple approach. So hopefully people appreciate that. Look, appreciate your work on it as always. Thanks for the deep dive.
My pleasure, Chris. It's amazing how many big issues can be solved by buying gold. Maybe I'm biased, but yeah, I'd love to be proven wrong on that one.
Well, the data was pretty compelling. Those charts were pretty clear. So thank you again. Thanks everyone for watching. We'll chat again soon.